Welcome back to Focus on the Future. Banks have been in the news of late, and most of the publicity has been bad. As we speak today, there are various demonstrations going on across the world that depict banks, among other financial institutions, as the bad guys. There may or may not be some truth in that. But should we all shut our bank accounts and find another way? Here at Focus on the Future, we believe that building financial relationships is the key to a successful financial future. One of the most important financial relationships is the banking relationship, in our opinion. So today, we are honored to have as our guest Mr. Stan Sluter, President of People's Bank. Stan will help us further understand the importance of a banking relationship and much more. Welcome to Focus on the Future, Stan.
Thanks, Skip.
Good to see you.
Nice to be here.
You know, before we get started on our questions today, if you would, just kind of share with us a little bit about yourself and People's Bank.
Great, I'd be happy to. I kind of grew up in banking. I started when I was 18 years old as a teller, paid my way through college, working part-time as a bank teller, and worked my way up and through the ranks there. Was one of the larger major money center banks for a long time, and when one merger took over another, I left that, and now I'm a part of a community bank network that is a little different, but still the same basic business principles. We like to think we're a lot more Main Street and a lot less Wall Street.
So you're telling me that you came from a teller to a president?
That's right.
That is actually possible to do in America?
Sometimes it's best to be the oldest cat in the barn.
You know, and that does make some sense, but it also gives us a little bit of insight into the banking arena, if you will, and a possibility of employment for folks, because it's a place where you really can start at the bottom and move all the way to the top, obviously.
Absolutely is. And what I've always liked about banking, I never set out to be a banker. I don't have a degree in finance. But what I found out about banking early on is it really is a helping profession. At the end of the day, we're here to help people achieve their financial goals. And so that's what I've enjoyed about banking so far.
I am really glad you said that. In fact, you're the first banker that I've ever heard really say that out loud. And I believe that to be true as well. And that's why we emphasize the banking relationship so much. And when I say that to you, what does that really mean, a banking relationship?
To me, it's understanding what someone's trying to accomplish. One size fits all just doesn't work, I think. But it's trying to understand whether you're a small business owner, you're trying to grow your business, whether you're a consumer and you're trying to put money away to save for a major financial goal, or purchasing a house, or paying for an education, or funding your retirement. We need to understand what those goals are and then help people navigate through the financial landscape so that they can try to achieve those goals most efficiently.
You know, a lot of folks today do all of their banking online. As a matter of fact, they don't even deal with a bricks and mortar institution. There are organizations like Ally Bank, for example, that I think is just an internet bank. ING does the same thing a little bit. Is there a difference, do you think? Is it important to be able to walk into an institution and know somebody and actually be on a first name basis with them?
I think it's important for everybody, whether you're a small business owner, or a household, running a household, or just getting started in your financial life, that you have some trusted advisor at some level. For me, the model that I think of most is walking into your community bank and sitting down across from your banker and talking about those things. But, you know, there's, for younger people and for folks that are more accustomed to dealing with the online, there's stuff like Motley Fool and other websites where you can go get advice, and then you've got to decide if it's best for you or not.
Right.
But there are ways to get advice that aren't the things that I think of. There's still a part of me that thinks about It's a Wonderful Life in that banking model, but I think that's getting further and further away from the typical reality.
Well, perhaps so. Well, let's just talk about the elephant in the room, if you will, because these demonstrations are going on, and there's no question that they've made the banks the enemy in a way. A lot of people are saying this is because of the debit card situation, that they're charging debit card fees and all of the fees associated with overdrafts and things like this. Are banks the bad guys here?
I think the banks have some culpability here. We're not without our share of the blame. But the reality of it is, you've got private enterprise, you've got private investors, whether it be through Wall Street or Main Street, where they've put their capital at risk by owning the stock of these banks. Now the government is controlling their revenue streams. Just like if the government went in and told Coca-Cola how much they could charge for a 12-ounce bottle of Coke, the government's come in and told us what we can and can't charge for some of our products and services.
Right.
Business is going to try to replace revenue streams. That's just how business works.
Sure.
And banks are businesses.
Right.
We're for profit. And so I think what's happened is with the new interchange fee limits and the things that came through Frank Dodd, banks, Wells Fargo and B of A and others have decided to try to replace those revenue streams with monthly charges. Other banks have chosen other ways to replace those revenue streams, but the revenue streams in business will be replaced.
So you think perhaps that this debit card fee is going to hang on because not everybody's doing it. Is this something that's going to be a trend, and eventually all of us are going to be facing that, regardless of where we bank?
I suspect, and this is just my opinion, this is going to look a lot like ATM fees did 13 years ago. Remember, used to be your bank would charge you if you used someone else's ATM.
Right.
Because they had to exchange that data.
Right.
And then about 13 years ago, the ATM itself started charging you. So a $20 withdrawal now costs you $21 plus tax. And the other dollar went to the machine owner. And the American public got all up in arms about how could we be charged to get access to our own money. And now we're going through the same thing. But now none of us walk up to an ATM and think twice about paying that fee.
Got a point. I guess once you get used to it and it's something that's not foreign anymore, it'll probably work. Now you mentioned the Dodd-Frank Act and the fact that had something to do with controlling fees in the banks. And then there was something called the Durbin Amendment, as I recall, that was attached to that. And that really is the reason why I think that these bank fees have come about. The reason I wanted to set it up that way is, do you think that government legislation at this point is overwhelming for banks, or can they work through this and work with the government?
Well, it's gone from underwhelming to overwhelming, and the pendulum will eventually swing back to underwhelming. But the reality of it is, a lot of the reasons for the economic crisis that we're all enduring right now is lack of government regulation and oversight on certain things like derivatives and mortgage-backed securities and credit default swaps. And so all this stuff was unregulated, and the American people were being taken advantage of to profit these big companies. And now the legislature is going to ride in on their white horse and protect us not only from the bad guys but from the good guys as well. So was ATM interchange fees exorbitant? Is that the reason we're having 8% of the homes in the United States in some period of foreclosure? Absolutely not.
No.
But was it wrong for banks to make sure that they cleared checks in such an order that they could charge you the most overdraft fees, or to set up these unannounced lines of credit so that a $4 cup of coffee was actually going to cost you $35? That's absolutely wrong. It's wrong to do that. It's predatory. And so the government was right to come in, but as they typically do, in my opinion, they've gone a little too far.
Okay.
And it'll swing back to the middle.
I wouldn't doubt that you're right. Speaking of fees, and you mentioned the O word, overdraft fees, they have been excessive, I think, and you're right. The banks did set it up so that the checks would come in a certain order where the maximum fees could be charged to your account. But now there's something called opt-in and opt-out, right? Mm-hmm. Where you can avoid the overdraft fees entirely. How does that work?
Well, you can avoid the overdraft fees to a certain degree. There's only one sure way to make sure you avoid overdraft fees, and that's don't write checks for money you don't have in your account.
There's a novel concept.
I mean, the concept of flow, the idea of I'm going to write this check today and it's not going to clear for 3 days, those days are gone. When you write the check, assume the money's coming out of your account that night. And if the money's not in there, then you can opt out by not ever overdrafting your account. Sounds easy, and for some folks it's hard to do, but that's just the reality of it. It's just the best way to make sure you're controlling this is know how much money you have in your account and don't spend more than that amount.
That makes sense, of course. On the debit card side of things, if I've set up a debit card account, a checking account with a debit card attached to it, I should probably say, then, and I've opted out, which means that I've told the bank you can't charge me overdraft fees, and so you won't do that. But let's say that I am swiping my debit card at a location that doesn't transmit their transactions every day. So it is theoretically possible that I could overdraft my account and yet you can't charge me a fee. Is that not a problem for you? And what would you do to me and with my account if I did that?
At our bank, our policy is excessive overdraft activity. Anybody can make a mistake.
Sure.
Forget to carry the 1 or forget to borrow the 9 or however all that math stuff works. Anybody can make a mistake, and we're tolerant of that. But when we start seeing excessive overdraft activity, we recognize that's bad for banking, it's bad for the businesses, and so we'll just close the account out. I suspect that's how other banks are handling it, but I frankly don't know that because I haven't done a lot of research into how they're handling that. But they're not going to be tolerant of overdraft activity that they can't charge for.
That makes sense.
Because it does pose risk for them.
Right, and an overdraft really is kind of a mini loan, isn't it? I mean, it's if I've overdrawn my account, in essence, the bank is loaning me money for a period of time. It would seem to me that they have the right to charge me something for that.
Absolutely.
That makes absolute sense to me. You know, most of us think of banking institutions as a place to park your money, a place to have a checking account, a convenient way to get cash at an ATM machine using our ATM and debit card. But really, that's not the entire function of banks, and probably not the most important function. The most important function is lending. Is lending as easy as it used to be, given the economic crisis, if you will, that we're in now? And do you see that credit is too tight, too loose? What's the picture?
I think right now, again, the pendulum has swung, and it's probably gotten a little bit too tight. Clearly, in the late 90s, early 2000s, it was way too loose. When our society, banks, Fannie Mae, Freddie Mac, all the housing institutions would let you borrow money with zero money down. No verification of income, no verification of your savings, and just basically tell us what you want to buy and we'll let you buy it. That's too loose.
Right.
And right now it's maybe a little bit too tight. And there may be some folks that are not able to take advantage of the current low price in housing, the current low interest rates because of that. But my experience over 20 years is that this pendulum will swing back to the middle.
Now, we talk about credit scores in this program all the time, and obviously that drives lending, doesn't it?
Absolutely.
What would you say the minimum credit score is that you would consider before you would say to a person, look, don't even ask us for a loan?
Yeah, I think in the Fannie and Freddie world, the 30-year fixed rate mortgage world, it's 640 or 660.
Okay.
Our bank's minimum is moved around a little bit now, and it kind of stays in those areas. But the reality of it is, if you want the best rates and the best terms, you need to be north of 700.
I got you. So if I come into your institution to borrow money and I've got a 650 score, you're not going to necessarily turn me away, but you may charge me more interest for that.
If the bank has a risk-based pricing model, which most of them do, you're going to probably be near the bottom of that pricing model, which is going to cost you more to borrow money.
Yeah, well, it's true in every types of lending. We were the previous show we had on last week was about auto purchasing, for example, and we talked about the fact that if you walk in with a low credit score, you're going to pay more for the car. So it's true in every type of loan, isn't it?
Not only in lending, it is true in every type of loan, but it's also true with regard to the premium you pay on your car insurance, your homeowner's insurance. Your credit score drives a lot more than just when you borrow money.
That's true. Let's talk about some of the types of lending that your bank does. Can you give us just kind of a thumbnail sketch of the types of loans you make?
The majority of the loans we make on a monthly basis are to help people either refinance or purchase their residence, their home. We do loans for small businesses, whether it's to buy an office building to occupy for themselves, whether it's money to a farmer to buy a tractor, or to a trucker to buy a new tractor and trailer rig to move merchandise over the road, to a dentist to buy a new x-ray machine. So most of what we do is to finance capital purchase items and make them, spread out the cost of those items over the life of the asset.
Well, another form of lending, if you will, is a credit card. Does your bank offer credit card accounts to your depositors?
We don't. That's an economy of scale thing. We just have chosen not to be in that business, but certainly a lot of them do.
Would you advise young people to get a credit card, or is that something that you would advise folks to stay away from?
It's kind of a two-part answer. I think that Americans that travel and that run their lives probably need to have a credit card, but really, really strongly suggest that they pay the balance off every month.
Well, yeah, because the interest rates are draconian.
They're very high, and even with the Credit Reform Act that I think we saw June of 2010, which did make them a lot more consumer friendly, the rates are higher. The default rates are higher than average, and those default rates just get built into the cost that the paying credit card holders they end up paying those.
Right.
The credit card company doesn't eat those. They're not going to lose that money or give it to charity. They're going to make sure they get that money recovered somehow.
Well, I know that you're a big advocate of saving, and one of the things that banks provide are opportunities for people to save money. Is it tough to open a savings account? Is that the same thing as opening a checking account? How does that work?
I think it's pretty simple. I would encourage everybody to go down and do it, find out how to do it so that they can, get used to the banking system while they've got some oversight and governance, maybe from their parents or guardians, and because banking is a good system of payments. It beats carrying around a bunch of cash in your pocket. If you want to go buy a airline ticket for whatever airline, it's a lot easier to do it online and use a credit card or a debit card than to drive all the way down to the airport and hand the gal $100 bills over the counter. So I think there is a place for the payment systems of banking and credit cards. But I would encourage people to go open a savings account. And what's interesting is, we hear so much now about, well, you're not paying any interest. Well, banks do pay very low interest right now because interest rates are low.
Right.
But the good news about a bank is if you put $100 in, you're going to get $100 back.
And well, that's right. It might be $104, right? It might be $105. It depends on how long you keep it in there. But the bank will pay you some interest.
Right. They will pay you some interest, and you will get all your principal back.
Right. Now, I'm also aware that you have a really unique personal savings plan, and I understand that it relates back to when you first paid off your first vehicle. Can you tell us just a little bit about that? We're darn near out of time. So.
Sure. No, we paid off a vehicle. One of my customers said, "What are you going to do with that money?" And I said, "Well, I don't really know." And he says, "If you don't do something with it, it'll just disappear. You'll spend it on other stuff." And he was right. So we, right away, the month after we paid that off, we started putting that money away every month into some investment vehicles.
How much was that payment?
$400 a month.
All right.
And I thought, well, I'll just do that until I've got to buy a car and replace that car.
Right.
Well, here we are 19 years later, and we still do that every month. And the other trick to that is when you find money in your budget, save it. And then two, don't look at the statements. Don't necessarily know how much is in there. Just make sure you're saving like you're putting in a piggy bank when we were kids. You'd put change in a piggy bank. You didn't know how much was in there. And that's good. Because
you don't want to break it open.
Right. Once you know how much is in there, the normal psyche is you're going to want to spend it.
Sure.
But you want to get in the habit of saving. And saving is just such a great habit for any person to be in.
That's the one thing that I found absolutely unique about what you do, because, guys, you got to know this. Stan does not open the statements on this savings account that he's been doing $400 a month for 19 years, did you say?
Almost 19 years.
He has no idea how much is in there, guys. One of these days, it's going to be a wonderful surprise for you, your wife, your kids. You guys can take one heck of a vacation.
Let's hope so.
I hope you invite me.
Okay, Skip.
Stan, thanks very much for being here today.
Thanks for having me.
Very informative. Thank you.
Great.
I thought that was a great interview. And what'd you think?
You know what? There's a lot of information when it comes to banking. It can be a little bit complicated, but the bottom line is it really makes all the sense in the world to have a financial relationship. You have to know somebody in a bank. You're going to need to know somebody.
Yeah, I think so. It's easy to bank online. I do it myself, and it's not very convenient to go into a bank. I understand that, but my gosh, when you need the help, you really need to know someone.
You really do need to know somebody. And you know what? It's your responsibility to keep track of your balance in your accounts. Don't expect the online statements to be exactly right all the time. The merchants may not have posted the payment to the account. There's all sorts of stuff. So you need to keep track of those balances. It's your responsibility.
Well, you really do, because if you're in an opt-out situation, which most young people are going to be, I think, and most folks, period, are opting out, and you find yourself in a situation where you've overdrawn your account, they're probably going to close it.
And the other thing that Stan was talking about, really interesting, how he saves $400 every single month, has no idea how much is in the account. And you know what? Saving isn't really a glamorous term, But you really need to be able to save your money because you might not need it right now, but I guarantee you at some point in the future you're going to need that
Well,
money.
I'm not sure how many people have the discipline of Stan Sluter to be able to not open it up for 19
I
years.
couldn't.
I'm not one of those folks, I can
There's no
guarantee
way.
you. But the key is, I think, and I think this is really what we were all looking for here, was the fact you got to have a plan of savings, and it needs to be systematic.
You need to do it every single month.
And the same amount. I think that makes sense as well.
Yep, absolutely.
So what's next?
Up next, we have Budget Busters, followed by the Stock Market Corner. Stay
All
with
right,
us, guys.
we'll see you next week.
Bye. Hi, welcome back. It's finally time to talk about the I word. No, not like I like to go shopping, but insurance. Why in the world am I calling it the I word? Simply because most of us hate to pay for something that isn't really tangible and may not actually use. But keep in mind, if you ever need it, you'll be so happy that you have it. When talking about insurance, it's important to know what kind of insurance you need and how much coverage is prudent and financially manageable. Now, I say financially manageable because you could insure everything up to a very high policy amount, but it's going to cost you. These are tough questions and they'll depend on you and your personal circumstances. So take a moment to review what you have and how much it would cost to fix or replace all of those assets. But generally speaking, you'll need auto insurance. That is, if you have a vehicle, health insurance, renters or homeowners insurance, and maybe even life insurance. So today, let's talk about how much of your budget should be allocated for insurance. Typically, as a young person, the most expensive insurance is your auto coverage. As far as I know, every state in the U.S. will require you to carry at minimum liability insurance to operate a motor vehicle. That's just the law. If you carry this minimum of liability and you're under 25 and single, you're looking about $100 a month. By the way, only having the minimum liability insurance probably isn't the best idea. It's risky when you stop to realize what a new car costs these days. What a bummer if you hit a new BMW that costs 80 grand. That would totally ruin my day. You should talk to your insurance agent to make sure you have the appropriate liability coverage. Remember back in episode 5 when we talked to Kathleen and suggest that you have an insurance relationship. If you have a loan on your vehicle, you'll have to have comprehensive and collision coverage. The more coverage that you add onto the policy, the more it costs you, so it's going to increase your monthly insurance payment. Here's my suggestion. Buy a car that you can afford along with the payment as well as the monthly insurance premium. Okay, let's switch gears to health insurance. Do you really need it? Yeah. It's possible that you could get sick or have an accident. Hospital stays are crazy expensive and can add up to thousands of dollars really quickly. If you break your nose, arm, leg, it can add up fast to fix, especially if there are complications. The bottom line, don't take the risk of not having some sort of health insurance. Catastrophic coverage is relatively cheap and could save you in case of a health emergency. Again, talk to your insurance agent. And finally, there's renters and or homeowners insurance, which protects your stuff due to loss of theft, fire, weather, etc. Do you like your stuff and want to keep it? Well, yeah, so this insurance is vital. Renter's insurance is a must if you live in an apartment or you rent a house. It's also fairly inexpensive, and you'll be so glad that you have it when you need it. Where do you find it? Talk to your insurance agent. See you soon. Hi, welcome back to the Stock Market Corner. I'm Emily New.
And I'm Tom Crow.
How's it going today, Tom?
It's very good.
Good. What's new in the markets? We've got exciting stuff to talk about.
It's the end of the month. Today's the last day of the month. Happy Halloween.
Yay.
And you can always count on the last day of the month and the last day of the quarter as being a little bit extra volatile. We did have one company called MF Global declare bankruptcy this morning, and that's caused a little bit of nervousness in the market. But as all the fund managers and investors that want to make their end of the month and end of the quarter numbers look good, they tend to take some profits. Last week was a very strong week for the most part for the markets, so a lot of folks have some profits to take, and they're going to make their books look a little bit better by taking some of those off the table.
So this is pretty predictable then, you're saying?
Absolutely.
End of the month, end of the quarter.
Not out of character in
Typically
terms
happens.
of volatility or anything.
Interesting. So happy Halloween. The markets are down a little bit.
Right.
But they had been doing pretty well, right?
Yeah, they had a great week last week with a little bit of the discussion in terms of some resolution in Greece as to how they're going to unwind that situation.
Yeah, what's going on there?
Well, they've agreed to take what the bond investors are calling a 50% haircut. And what that means is when the people bought the bonds, the Greek bonds, they bought their debt at $1,000, just say $1,000 a piece.
Okay.
And Greek, while they're using that money, is paying back the investors' interest. And then when the when the bond matures, kind of like a 30-year mortgage, when that 30 years is up,
Right.
you get your money back and they quit paying you interest. Well, instead of getting the $1,000 back, now people who bought those Greek bonds are only going to get $500 back for every bond they bought.
Oh.
But
At least they're getting something.
they're getting back 50 cents on the dollar,
Yeah.
which is better than nothing. And
Right.
you know, a quick example is General Motors.
Mm-hmm.
People who had General Motors bonds, when the Obama administration came in and reorganized them, their bonds went away. They
Oh,
went
wow.
to zero. So they lost everything. So
Yeah.
they'd been getting some good interest for a few years, and they were a pretty highly rated company, but they got themselves in some trouble. And there was plenty of indications out there. And then we were talking about, where do you find this information?
Yeah,
So,
how do you know who you should buy bonds from?
whether it's a country or a company, you can always find that information as to how much leverage, how much debt they're in, how much cash flow is coming in, and whether or not they'll be able to perform on their obligations. So you look at the bond rating agencies, and I guess we'll do a kind of a bond 101 today.
Yeah, that sounds great.
Buying a bond is buying debt. So a company's running along, but they need more money to expand and they don't have it out of cash flow. So they go into the market, they sell bonds. That gives them cash to use. While they're using your cash, they pay you interest for a certain amount of time, whether it's 3 months out to 30 years. And they'll pay you interest for a while. Then when the term is up, or they decide they want to be free of that obligation, if it's a callable feature on a bond, then they basically just give you your money back and quit paying you interest. And you get back everything you put in. Now there are agencies out there like S&P, Moody's, Fitch, several of them, and they have bond ratings. And everybody
good.
says bonds are safer than stock. Well, there's bonds that you can get that are very risky, called junk bonds. And a lot of municipal bonds, when we started to see this government decline, kind of reached junk status when California was handing out
Right.
IOUs. I think Indiana, maybe Illinois was another one. Florida was having some trouble. It wasn't looking like they had enough tax revenue to meet their obligations on their bonds, so they were seeing their ratings lowered. And you know, you talk about buying stock in a company and you hope it's going to go up. Well, if you're going to buy a bond in a company, you hope they're going to be able to keep paying your interest and pay you back your money
And it's a
when the
longer
term is
term,
up.
yeah,
Tends to be a longer
than the
term,
stock.
but there's certainly, you can take every bit as much risk. And the scales, I think everybody agrees that AAA is the highest. You know, that is considered the highest level investment grade. That is up there, you know, along the scale of our U.S. government Treasury obligations.
Right.
Those are pretty much, they say they're guaranteed. You know, people always want to raise a red flag and say the government could default someday. Some states and some cities actually have defaulted, but it's so few. They tend to be very stable investments, and a lot of big companies tend to do very well for a long period of time. But you know, some little startup company that doesn't have any proven revenue, that has maybe
Right.
one or two sources of technology, some of the high-tech startups, Silicon Valley a few years ago, some of the biotechs that are really kind of cutting edge, but they only have one thing to bank on, and if an FDA approval doesn't come through, they're
they're
done.
sunk,
You know,
yeah.
if you loaned them money, you're probably not going to get anything back, and that's what you get into the double Bs and triple Bs and C minus and even unrated bonds, which can be every bit as risky as a stock.
Well, is there a process that these companies have to go through in order to issue their bonds, or can I say, hey, I have a company and you need to buy my bonds?
If you're going to sell bonds, you do have to go through a certain approval process, and whether a bank is going to guarantee it or you're going to go through a full-blown rating process through S&P or Moody's or Dun & Bradstreet or something like that. But yeah, if you're going to sell bonds in the securities market, it's going to have to go through an approval process, and it's going to fall under some SEC scrutiny as well.
And is there a certain amount that they can distribute? I mean, is it like stock? Like there are only so many shares that can be put out to the public. Is there only so many bonds that a company can offer?
It has to do with the size of the company and their
Okay.
operating revenues. You know, the higher risk you are, the more leverage they're going to take. So if they're $1 million company and they're going to go out and sell $10 million worth of bonds, that's going to be really high risk. If they're $1 million company and they need $1 million, you know, that's probably going to be okay.
But if they're trying to put out way too much, that
If
should
they're
be a
trying
little
to
bit
put
of
out
an
way too much,
indicator.
that's a red flag. You know,
Okay.
it's going to be obvious that, well, let's see, they're taking on this amount of debt at this interest rate and they've only got this much cash flow. The two don't add up. They're going to come up short right out of the gate. That's something you really want to avoid unless you've just really got money to throw away. The payoff can be
don't.
high. Now, in order to do that, they're going to have to pay you a really high interest rate to take that risk.
Oh, okay.
So while they're paying, you might do pretty well, but the risk of losing
Maybe
your entire
long-term.
principal is always there.
A little iffy. That's interesting stuff. I mean, I don't know. I don't want to be throwing my money away. So I guess it goes back to doing your homework.
You've got to do your due diligence.
You really
You
want to
really
make
do.
sure that these companies have the ability to pay you back. Because
Right.
I work hard for my money. I think most of us do, and we don't want to just lose it potentially.
And don't just say that, you know, stocks are risky, bonds are safe. You can take just as much risk in bonds. And there are stocks that hardly move and pay a decent dividend that almost act like bonds.
Well, the bottom line is investment does have some risk. I mean,
It all does.
whether it's stocks, bonds, mutual funds, whatever the case is, you're potentially putting your money at risk. However, the potential of getting more money back,
Right.
the reward.
Because just
is
sitting
lot.
in a savings account doesn't really pay you anything.
Yeah, I'd like to get a little more money than what 0.5% they're
Maybe.
averaging.
Yeah, they're pretty
Kinda
weak right now.
crazy. Yeah. Well, so you're attributing what's going on with Greece and this bankruptcy to the markets being a little sluggish, but we're going into the holidays and a lot of retail happening. And I just heard on the radio too that Macy's is going to be open at midnight,
23 hours straight.
23
Yep.
hours straight, starting the day after Thanksgiving, which is the whole Black Friday,
The big
right?
Black Friday, big shopping season's kicking
So,
off.
holy
Consumer
cow.
sentiment's up a little bit. We just heard this morning that the prediction for Halloween spending is up about 9% this year over last year. So even
Yeah.
though the economy seems to be weak and unemployment is still staying pretty high, people are spending money. We had Puss in Boots was released this weekend and made $34 million.
That's
the leading,
crazy.
family movie. So people are still spending money.
Yeah. Well, I think when it comes to these holidays, people still want to enjoy them despite
Sure.
what's happening throughout the year, despite the lack of the strength in the economy or maybe jobs, things like that. They still want to go out and buy a Halloween costume, and they're not cheap. And, buy Halloween candy for the trick-or-treaters, and
Right.
all of that stuff kind of plays into
Now,
it, I think.
October traditionally starts what is one of the best periods in the market.
Oh,
we,
good.
we always see, we talked last time about how September is the worst month historically.
Mm-hmm.
September was awful. I think we
Yeah.
ended up losing 10% or something in the markets. It was,
Yeah.
was a terrible month, but starting October through April, something around tax time, April 15th,
Yeah.
tends to be the best historical time to be in the market. I don't know whether it has to do with all the consumer spending that goes on year-end holiday stuff, people getting ready for taxes, people you get this lull after Christmas where a lot of the risk seems to come out of the market for a while, and it's just a good stable time to be in. But
Yeah.
that tends to be the best time to start getting into the market. So if you're thinking about still getting in, we're talking about dollar cost averaging into funds, this is a good time to start buying in.
And not just to randomly get in, kind of like we're talking about just throwing your money in the
Don't
market.
just throw
but,
it in.
But think about it.
Do
Talk
your
to
homework,
somebody who's qualified.
Find something strong
Yeah.
and something that's going to be safe.
Makes sense. Well, let's talk about our portfolio.
Real quick, our portfolio,
Yeah.
as of Friday's close, was looking really great because we had a great week. Abercrombie and Fitch were sitting on a gain of just over 10%.
All right.
Atmel is almost 10%, 9.85. Bed Bath & Beyond is just above break even, but it is positive. It's just a little less than 1%.
Good.
Kohl's was up 5.6%. And the one high risk one, the Brazilian steel company, whose name I still can't pronounce, SID is the symbol, 14.6%
Holy
profit.
cow.
Now, you remember last week we were down 10%. So that's a 24-point swing in
That's
just a
huge.
week. That's what we talk about risk when we talk about leverage. So that's a high risk stock. The potential's there to make a lot of money, but the potential's also there to lose it, and you can see it move a lot.
Yeah.
So that's also something to talk about our 10 and 10 or 20 and 20 portfolio. If you put your stops too tight on that, you'll get knocked out in no time, and you never really give the stock a chance to run up. Like I said, I think this company is probably about a $20 to $30 stock. So my inclination is to
And
stay
what do
in
we
it
buy
and
it
let
for?
it run. We bought it for $8.63, and it's at $9.89 as of
So
Friday's
you think it
close.
has even more potential
Oh, I
to
think
go
I
up.
think it could easily double
Okay.
if it's able to reach its real intrinsic value, which is what you look at the numbers and you think this is what the stock should be trading at based on historical averages, what the rest of their competitors are doing, what the underlying raw material is doing, just the
Right.
steel industry itself. If we are going to see economy start to ramp up, China's going to have to start building roads. We're going to have to start putting people to work building bridges and infrastructure. Then you're going to have all that steel that goes in that concrete and all
Needs
those
to be
roads
used.
and bridges. They're going to have to produce a lot of it. So, you're looking at steel companies right now starting to ramp up a little bit, all the raw materials, the aluminum, the copper for all the wiring that has to go in. So, we've said
stuff.
there's so many moving parts in this, and you
Right.
don't have to know all of it, but you should have your ears open to what's going on. Okay, we just had these big storms sock in Pennsylvania area.
Right.
Well, last year we had a big winter storm that shut down the entire eastern seaboard for a while, and that really impacted the economy. So if you had stocks that were heavy retailers, the Walmarts and the supermarkets and the chains and stuff, and they got clobbered because people weren't leaving their houses to go shopping.
Right.
So you kind of got to keep a finger in the
about it
wind to
objectively.
everything that's going
Yeah.
on out there and keep an eye on what's happening and how it might affect your investment portfolio.
Well, it makes sense. And again, this is just our virtual portfolio. We're
Sure.
just kind of playing around. We don't actually have money invested in this, and we're not advocating that you do it either. Tom is a registered advisor. However, we're not
That's right.
pushing these companies at all. We're just kind of playing around and seeing if we were to put some money into the market in these companies, what would happen. And right now, you're doing great. So
And
those
this is a great way to start. Don't throw real money in it to start with. Do it
Just
on
follow
paper
it.
and let it go and see how you do.
sounds great. Well, this has been the Stock Market Corner. Stay with us, guys. We'll see you next time.
See you next time.
And now your questions for classroom discussion. Number one, what is a banking relationship? Second, How much of your budget should you allocate towards insurance premiums? And finally, what are you buying when you buy a bond?